Now that we focus on the structure of financial statements for a manufacturing enterprise, let's focus on analyzing these financial figures. So firstly, we are going to look what analysis we can do in terms of the production cost statement. Now the key you will see with much of this analysis is to always divide things by the number of units produced. So we can take the direct material costs and divide it by the number of units produced to get the direct material cost per unit. Similarly, we can take the direct labor costs and divide it by the number of units produced to get the direct labor costs per unit. We can get the direct cost per unit by simply dividing the prime costs by the number of units produced. The pattern should become obvious. We can get the factory overhead costs per unit by dividing the factory overhead costs by the number of units produced. We can take the cost of production of finished goods divided by the number of units produced to get the cost of finished goods per unit. So let's investigate the income statement, what we can do with that. Well, we can get the selling price per unit by taking the sales price, or the sales rather, for the year and divide by the number of units sold. We can get the gross profit on finished goods sold by taking the gross profit, dividing it by the cost of sales and multiply by 100/1 to get the percentage. We can get the selling and distribution cost per unit by taking the selling and distribution costs divided by the number of units sold. And similarly, we can take the administration cost divided by the number of units sold to obtain the administration cost per unit. Then, in order to determine the break-even point per unit, we are going to use here a slightly different approach than we have done previously. We can calculate the variable cost per unit by taking from our production cost statement the direct material cost per unit, adding the direct labor cost per unit, and adding the sales and distribution costs per unit. We can get the total fixed costs by, from our production cost statement, taking the factory overhead costs and adding the administrative costs. To get the contribution per unit, that's the same as always, selling price per unit minus variable cost per unit. So the break-even point is therefore the total fixed cost divided by the contribution per unit. So the results of these calculations can be analyzed and interpreted as follows. The direct material cost per unit. This indicates the cost for the material of 1 unit, as it's a unit cost. If the prices from suppliers increase, this figure will increase, so it will cost us more to produce the product. If, on the other hand, we are able to cut our raw material by careful planning so that there is less waste of material, this figure will decrease. Direct labor cost per unit. This indicates whether the manufacturing of the product is labor intensive or not. So the higher the direct labor cost per unit, the more labor intensive it is. It's also an indication of the productivity of employees. So the lower, the more productive the employees, obviously. Direct cost per unit, this indicates how efficient the manufacturing process is. The less the cost per unit, the more efficient the process is. This should not increase too much from one year to the next. The business will first look at this to determine the prices for the quotation when it wants to sell products. Cost of finished goods per unit. This will decrease if the factory is more productive. This is the total cost per unit. So we need to make sure that our selling price per unit at least cover that, plus the sales and administration costs, well, which is already included in it. Factory overhead cost per unit. This will decrease if the business can manage to produce more units, as factory overhead costs are a fixed cost. Percentage gross profit on cost of sales. This shows how much profit the business made per item. This should be enough to cover all the other expenses like sales and distribution costs and administration costs. Selling price per unit. This is the average price at which the units were sold during the year. Selling and distribution costs per unit. Selling and distribution costs will increase if more sales takes place. However, the selling and distribution cost per unit will stay the same, as this is a variable cost. Administration cost per unit. This will decrease if more sales takes place, as it's a fixed cost. So administration cost per unit and selling and distribution costs per unit, in a sense, goes in the opposite direction. This concept is called economies of scale. That is, as more is produced, constant administration costs are shared over a greater number of units.